Welcome to this Killik Explains finance video. This week, why predators can be poor investments. So, what's the problem? Well, basically, CEOs love M&A activity. In 2017, according to Dealogic, end of September, deal activity, a bit like 2016, had hit something like $2.5 trillion US. That's a lot of companies buying or merging with other companies. Bankers and advisors love them too because they normally take a fee which can be a percentage of the value of the deal. The bigger the deal, the more they earn. All right, but investors should watch out. M&A sounds exciting. CEOs will sell it to you as adding lots of value, but actually, in a lot of cases, it doesn't. Now, what's the evidence for saying that, making that bold claim, if you like? Well, it's not my evidence directly, but S&P, Global Market Intelligence, a respected unit, have looked at the performance of the Russell 3000, an American index, between 2001 and 2017. And what they've discovered is that had you put $1,000 to work in the broad index of all firms, it would have tripled over that time period. Had you, on the other hand, gone shopping and invested money in an index that comprised basically companies that were doing big deals to buy or merge with other companies, so more than 5% of enterprise value, to give you the technical description, your money would have doubled. Now, a lot of people might have said, well, doubling my money is not bad, but actually for less effort, you could have tripled it in the broader index. So that suggests that some of these big deals are just not working out very well. So, the basics, nuts and bolts. Back to beginning for those people who are not sure about M&A, what that means. So, takeovers, first of all, mergers and acquisitions. What are acquisitions? Well, this is where a firm makes a bid for the voting shares of another firm. Effectively, it wants to take full control of it, let's say. Usually involves a substantial amount of cash, which the predator has to offer to the target's shareholders in the hope they'll take the offer. There's a process there. The predator then controls the target, tries to buy up as many voting shares as it needs, a majority, to control the target. And an example, Microsoft bought LinkedIn. There was some competition, other people quite fancied it, but Microsoft won the battle, as it were. Now, mergers have a similar impact in a way. This is two firms of a similar size, usually, agreeing to combine to form one merged entity. So it's typically a share-for-share exchange on terms that suit both groups of shareholders. And an example would be DuPont and Dow merging to create a much bigger company in the chemicals sector. All right? So you'll see examples of both in your travels. But here's the point. Basically, how much value are these massive transactions actually adding to shareholders rather than boards of directors? Now, why do CEOs love to buy? And CEOs will always justify buying other companies if they can. Well, the economist Buttonwood sums it up nicely. Buying another business looks like decisive action, doing something, and it's a lot easier than coming up with a new best-selling product yourself, growing organically if you like. It's faster, it's easier. But actually, is it? Let's take a look at that in a moment. So, CEOs love it. There are other attractions too. Debt is cheap at the moment, so borrowing to buy another company doesn't cost as much as it might. And plenty of companies are sitting on cash piles and wondering what to do with them. So there's money to fund these deals, basically. It's better to be an eater in the corporate world than to be eaten. So companies think, crikey, I better be a predator in case I become a target. And running a bigger firm means you get more rewards. So CEOs like that. What's not to like if you're running a bigger company rather than a smaller company? And there's an accounting quirk on top. So here's one for the finance director. A predator buys a target, making £100 million a year, halfway through 2017. Very simple example. According to a quirk of the accounting rules, if you like, that's all you need to know really. 2016, the new combined company, when it produces its results, will show nothing from the target, because it hadn't bought it yet. All right? It will show half the profits for 2017 as a contribution from the target. And then next year, if we maintain this level of profitability in the target company, we'll get 100 million added to the combined group. If you're thinking, what's my point? It's that the target's profitability hasn't changed in all 3 years, and yet the profile it's adding to the group looks a bit like growth if you're not looking carefully. So there's another bonus. So what's not to like? If you're an investor, what's the problem? Well, basically, some more stats. S&P's Global Market Intelligence Unit again, looking at the Russell 3000 again, same period, 2001, 2017, said, well, basically, what's going wrong is this. Debt-related expenses tend to increase as a result of all this M&A activity. Net profit margins actually tend to fall, despite what the CEO might claim to the contrary when they do the deal. And earnings per share growth tends to decelerate. Not in all cases, but tends to. So what's going on? Well, CEOs will claim that M&A is a great idea because they can cut costs. The combined group can cut costs. It'll be more efficient. There'll be synergies, centralised purchasing. These are just examples. Combined research and development efforts in the tech sector, for example. Slicker sales pipeline, fewer competing products, improved marketing, spend and targeting and all that good stuff. But actually, the reality can be different. Acquisitive CEOs often take their eye off the ball. All right, they prefer to do a deal than actually manage the integration of two businesses afterwards. You get corporate culture clashes, systems that don't combine, processes and personnel may not blend together, top people leave and all the rest of it. And basically, therefore, the front end of a deal is much easier to organise than, if you like, the back end. And that's where things can start to drag and go a bit wrong. Now, the warning signs. So some deals are better than others. So the wheels are more likely to come off a deal, and these are just indicative. All right, if the predator firm is fast growing. Because if they're buying, they're probably not doing any of the back office integration correctly. All right, and eventually that will tell. The deal is big. The bigger they are, the harder they are to integrate, as a rule of thumb. And here's a quirk, the deal is all share rather than cash is indicative. Now, I'm not saying that will always go wrong, but those are indicative factors that tend to lead to subsequent underperformance. Okay, a closing thought then. So this is a cliche, but it's a good one. Buy the target and sell the predator. Experienced investors will tend to not buy predator companies, they'll buy targets instead. But it's not easy. You need to know a bit about the markets to be able to spot fast-growing smaller firms that might attract a bid, but often that's where the money is, rather than buying the predator, if you like. And investors need to watch out for M&A activity because, number one, deal chasing, especially on the predator side, isn't a great idea. It can put you off. It's noise, if you like. And secondly, be aware that people tend to sell stuff when it's worth a lot. So quite often, big volumes of large deals can suggest that the market's getting a bit frothy. All right? So another reason not to chase the money, if that makes sense. There we have it. Any questions? editor@killik.com. And to watch other videos related to this one, killik.com/learn and click the Equities tab.